Aloha and good morning, Friday. I hope everyone's had a wonderful week and you've survived the rains earlier this week, of course. Our crazy weather that comes and goes, of course, here in Honolulu, but we're back to some lovely sunshine here. I'm pleased to welcome back Duncan Hsia. He's the owner of Infinite Financial and he's learned, his expertise. We've learned so much through listening to him over the year. And today we're going to talk about some new loan programs and what we've got installed for 2022. So with that, Duncan, I must admit I had an email from you about 2 weeks ago about a new loan program, and I was so excited and I wanted to get it out there for our listeners and clients. And maybe you can introduce that program today.
Sure. Yeah. So it's actually the already existing conforming loans, conventional loans. The max loan amount has gone up from $822,375 to $970,800. So it reflects the increase in values in the home market. So the Fannie Mae and Freddie Mac owner of the body that regulates the guidelines for conventional loans increased that loan amount for Hawaii to $970,800. So people buying at that single family home level, that's over $1 million now. Now they can qualify for a conventional loan at a much higher level than before. Just a few years ago, it was at $625. So we've had a big increase in the loan amount for conventional loans, which helps quite a bit for qualifying because the guidelines are much more forgiving on a conventional loan than it is on a jumbo loan. Jumbo loan guidelines are much stricter. A higher debt to income ratio is allowed on conventional loans, and you have a lower interest rate too. Normally, conventional loans have a pretty good discount on the rate versus a jumbo loan. So the combination of those plus being able to buy with as little as 3% down on a conventional loan makes it work a lot better for a lot of people. And one of the things I mentioned in that email is we do a lot of loans in conjunction with a HELOC, a piggyback HELOC we call it, and that will help buyers fill the gap. So for example, if someone wanted to buy a property now at with a loan amount of 1.2 million, they're buying something say for 1.5 million, and they had $300,000 down, they wouldn't have to go with a jumbo loan. Another option would be to get a $970,800 first mortgage and then to do a piggyback HELOC for $230,000 to fill that gap. So that allows them to get the easier qualifying of both the first mortgage as a conventional loan, and HELOCs also have looser guidelines for debt to income ratio. So someone who may not qualify for a loan, a jumbo loan of that size, could qualify for a conventional loan using the conventional guidelines and a piggyback HELOC, and that allows people to buy where they wouldn't be able to before the changes to the rules.
Well, it's interesting. And, I think the qualifying is huge. I remember years ago when people would go into a jumbo loan setting and all the rules change, and it doesn't sound like that's changed too much. So having that higher loan amount, of course, is amazing. And then how about interest rates? I know interest rates change daily, but, on a jumbo fixed 30 years versus a conventional loan, what are the rates we're talking and the difference right now?
Oh, it depends on the credit score and the down payment and occupancy, but in general, for a primary residence with good credit, you could get, and it depends on the points that you pay too. But generally, on a primary residence in the upper twos, close to the 3 area, whereas on a jumbo loan, in general, you're going to be into the mid 3s. Though you can get lower, depending on the points that you pay and the different situations with bigger down payment, it can be lower. So there's a lot of variables in the loan business, but in general, it's about 3/8 to 0.5% higher on a jumbo loan than it is on a conforming loan.
Great. And then, talking about interest rates, what are some of the, great programs out there? Sometimes I see 3 or 5 year ARMs or a 7-year ARM, and I go, whoa, that's a good program for somebody who doesn't want a fixed 30-year mortgage, for instance. What would you say some of the
there are different programs that are? Yeah, for some people, ARMs are good, but most people have been going with fixed year loan. If you're going to be in a place for the long term, most people have been choosing to go with 30-year fixed. That's been the vast majority of loans. because you lock in such a low rate. We're still at historically super low interest rates. And so if you can lock that in for 30 years, 20 years from now, rates could be double or triple what they are now. And you still got a loan in the 2s or 3s. And so it's great to have that. And you might be able to make money. It's inconceivable now, but you might be able to make money in a savings account at what you're paying on your higher than what you're paying on a mortgage now. So it doesn't really make sense to not have that type of long-term money if you have other places to invest your money or you have other uses for your cash. So it's a great opportunity for people to lock in long-term. ARMs, my first house I bought using an ARM, but that's when rates were, we got a 5-year ARM and it was in the 7s on the rate. Fixed loans were in the 8s. And so it makes sense in a declining market. I refinanced several times on that mortgage. In a market where rates are super low, in general, it makes sense to lock in a long-term fixed rate when you can. A lot of people are doing other types as well. You have a 15-year, 20-year, you can do any number of years in between. The rate gets a lot better when you do 15 years and shorter. ARMs, after your initial fixed period, the adjustable rate mortgage rates can go a lot higher if the short-term rates are raised quite a bit by the government. Some people can't foresee the government raising short-term rates anytime in the near future, but you never know what the future is going to hold. With an adjustable rate mortgage, you have that uncertainty, and you never know. 10 years from now, rates might be a lot higher, and you might be stuck with paying a lot more if you keep the house. If you're going to be moving in less than the 5-year or 7-year term, then it's not something you would need to worry about. So it really depends on the customer's needs.
No, and it just seems like there's so much creativity in the mortgage business again, which is great to see. And I believe we might have spoken, but I wanted to bring it up again. And I know, I deal with a lot of luxury buyers, and a lot of people might be semi-retired and working in the stock market, of course. And it was so hard to get a loan before, but I believe there's loan programs now, right? Portfolio loans that they can get on their stock profile and everything.
Yeah, they're asset participation loans, and we have some creative ways to create streams of income from portfolios. So we do that quite a bit to allow customers to qualify, whereas other lenders can't qualify them. So we take over a lot of loans from other lenders where they can't get the customer to qualify, but we have creative ways to make things work.
Yes, and then of course we have somebody who's just coming new into the market, or maybe they had a life change. And what would be 3 or 4 things you would tell somebody to get ready to take out a mortgage, say for next year, in terms of getting their credit straight? Should they open a new credit card, or what are some of the things they should do and don't do, I should say?
They probably should not open a new credit card. Usually when you open usually when you open a new line of credit right before you apply for a mortgage, that's going to drop your score initially. Over the long term, if you have a year or 2 ahead, then it might make sense to do that. But it's really a custom case-by-case situation. So I'd really want to talk to a customer about their credit situation, and if it makes sense to open or add on additional credit lines, or pay off things or dispute things. There may be things that you have on a credit report that you had no idea was there and it's incorrect. So it's good to address those beforehand. Credit score is the big thing to make sure it's in good shape before you buy a place. Not only does it affect your qualifying, it affects the rate and the points that you're going to pay, and it does affect whether you can qualify for a loan and which type of loan programs you qualify for. So credit is a big thing. Having the down payment in order, how much you're going to put down, knowing what you want to put down, what type of place you're going to buy, because the down payment can have a huge impact in the price that you pay, on the rate and points. And so you want to plan that out and try to get that into the best position. Your credit, your assets for the down payment, what sources are you going to use? Some people these days with the high loan amounts, with high prices, a lot of people have been using gifting from relatives, which you can do on owner-occupied loans and some investment loans. And you also can borrow from your retirement if you have a company plan. A lot of times the company plans allow for borrowing and paying yourself back over time. I did that for our first house purchase because we had I had a sizable retirement account that from my employer, and I was able to borrow against that to come up with a nice down payment to reduce the mortgage insurance costs and other closing costs. So one thing is to make sure you have enough funds for the down payment and closing costs, have your credit in order, and to have a pretty good idea of the type of loan. Most people will go with a conventional loan, or if they're qualified with a VA loan. But there are situations where you may want to go with a USDA loan or an FHA loan or a portfolio loan, depending on the type of property too. Some properties you cannot buy with a conventional loan or a VA loan or FHA loan. So depending on the type of property you're looking at, sometimes I'll have people come to me and they want to buy, for example, a condotel, and they don't realize a condotel has different financing requirements from a single family home. So it's important to plan ahead so you're not caught when you want to submit an offer and say, oh, I didn't realize I have to put more down, or the rate's going to be higher, or these other programs that are available on a single family home are not available on the type of property that I'm wanting to buy. So it's important to plan ahead so you know that you're ready and how much you can qualify for. So it's important to talk to a loan officer to pre-approve you, or at least to give you an idea of what you may be able to qualify for. And if you can't qualify for something right now, to give you the steps that it would take to get to a position to be able to buy what you're looking for.
And, a key thing I'm hearing, Duncan, there is, planning and, taking that time to plan,
right.
plan. And so going into that, what can we expect in 2022 so people can start planning around, real estate and their refinancing or mortgages? What do you expect?
Well, we've seen that prices have, one thing we've seen that prices have gone up quite a bit, and we probably will see prices to continue to go higher, at least over the long term. And in Hawaii, I don't expect prices to take a big drop in Hawaii. If anything, they might plateau, and certain areas might have fluctuations. But overall, it's a very strong and solid market because you have buyers coming from all over the world. We deal with customers from all over the world looking to buy here, especially now with the change in the work environment where a lot of people can work remotely. You have a whole group of potential buyers that can work anywhere in the world, and so many of them with a lot of funds would like to live here. Why not live in Hawaii when you can escape the winters and the bad weather and live in paradise? So absolutely. We do get we're seeing people coming in, a lot of buyers that are able to come in and work remotely from here and become residents here, and we have people buying a second home and vacation. So that demand, the underlying demand, is always there, and as the economy has opened up, you have more people coming back, and we've had strong prices recently with a lack of visitors from Japan. So once that opens up, you get more visitors from Asia with COVID subsiding. We'll probably have more demand and a lot of cash buyers from those. There's a lot of money that's been pumped into the economies worldwide by the central governments. So we have a lot of demand, and I don't expect a big drop in housing prices like happened 13 years ago. With back then, there were all kinds of, it was kind of a house of cards. You had all kinds of mortgages that should not have been done.
And interestingly enough, I think I spoke about it a few weeks ago, is, over 50% of the luxury home sales last month all sold at asking or above asking.
Right.
So even with that statistic, it doesn't show you the prices are going down anytime soon.
Yeah, and we still have a lot of buyers who are pre-approved, trying to submit offers on places with many offers and trying to compete with other offers. And it's a tight market, very low inventory, a lot of demand and not enough supply, and the permits being allowed. We have limited land here, and the permitting for new construction is not very easy. We have new housing permits that are not enough to sustain the demand, the demand for new housing just from people here, and then you have other people coming in from all over the world. It's a very strong market, and I don't expect that to change anytime soon. Overall, who knows what's going to happen with the overall global economy? So there might be some effects like that. There's some people that are worried about the stock market and the global economy, but we're coming out of kind of a semi-shutdown economy, and things are opening up. So you got a lot of demand that comes here from all over. So helping to sustain the market here. So even back in 2008, when things dropped worldwide and the rest of the country dropped more than here, you see prices fluctuate a lot more in other areas than here. So if you look at the analysis from different economists, you see that the housing market for Hawaii has been much more stable and much more tracking to long-term trends than in other.
Absolutely. Well, I thank you for all your feedback today. I mean, we could talk forever.
Yeah, it was
we'll save that for the new year.
Sounds good.
No, definitely. And I wanted to share Marianne's photos again. We do that every session here. And of course, we've talked about all the snow on the mainland, and it seems very cool, but in Hawaii we still have our vibrant colors even after our heavy rains. And she brought a color element into all her photos today, and even like beautiful rainbows around. And I noticed on Instagram someone's listing on the North Shore had a beautiful rainbow, so we're getting rainbows all over the island. And of course the hibiscus, and these were just taken within the last week, and just beautiful. And no wonder everyone wants to come to Hawaii. It's a beautiful place to be. And Duncan, Merry Christmas and Happy New Year. And we will catch up, and I thank you for your time today.
Thanks, Caron.
Oh, you're welcome.
It was a pleasure.